2008. The year Twilight hit theaters, people were still using MySpace unironically, and the global economy collapsed faster than my motivation to hit the gym in January. Welcome to M Squared. Today we're tackling the wild roller coaster that was the 2008 global financial crisis, what caused it, how it messed up the world, and what's been done since to, hopefully, avoid another disaster. Spoiler, it involves a lot of bad loans, fancy financial terms no one understood, and banks that partied a little too hard. Let's break it down. First up, what caused the whole mess? Picture this: banks, investors, and lenders were basically throwing money at people to buy houses. Didn't have a job? No problem. Terrible credit? Lenders were like, it's fine, here's a loan the size of Texas. This wasn't just optimism, it was delusion wrapped in a mortgage. These weren't just regular loans, they were subprime loans, which is finance speak for high risk, but we'll deal with it later. The idea was that housing prices would never go down, so even if borrowers defaulted, the banks could sell the house for profit. It was like betting your entire life savings on a unicorn winning the Kentucky Derby. Now this is where things get spicy. Banks didn't just hold on to these risky loans, they bundled them together, slapped a fancy label on top like AAA rated because why not, and sold them as investments called mortgage-backed securities. Think of it like taking expired sushi, wrapping it in glitter paper, and convincing people it's Michelin-starred. Investors bought in, hard. These securities spread through the global financial system like glitter at a kid's birthday party, impossible to clean up. Everything seemed great, until it wasn't. By 2006, cracks started showing. Housing prices stopped rising, and suddenly, those risky subprime loans began to rot. People couldn't pay their mortgages, foreclosures skyrocketed, and banks were left holding the world's most expensive collection of worthless houses. In 2008, the bubble burst. Lehman Brothers collapsed, banks started dropping like flies at a bug zapper, and suddenly governments were scrambling to prevent a full-on apocalypse. The entire financial system was on life support, and taxpayers had to step in with massive bailouts. And let's not forget the human side of this disaster. Millions of people lost their homes, jobs disappeared overnight, and retirement savings evaporated. It was like musical chairs, but with 90% fewer chairs and way more existential dread. But wait, it wasn't just an American problem. Thanks to globalization, the crisis spread faster than gossip at a family reunion. European banks were neck-deep in those toxic securities, and countries like Greece, Ireland, and Spain faced full-blown economic meltdowns. The world collectively realized that when the US sneezes, everyone else gets pneumonia. So what did we learn? After 2008, governments rolled out new rules faster than a teacher after a class prank. The Dodd-Frank Act put stricter regulations on banks, making sure they couldn't go full Vegas mode with other people's money. Stress tests became a thing, basically, financial fire drills to see how banks would handle another crisis. The US also created the Consumer Financial Protection Bureau, whose entire job is to stop predatory lending and make sure banks don't hand out mortgages like Oprah handing out cars. Europe set up similar watchdogs to keep financial institutions in check. Could the 2008 crash have been prevented? Oh, absolutely. If banks hadn't handed out risky loans like candy at Halloween, if regulators had asked any questions about those sketchy mortgage-backed securities, and if the words too big to fail weren't a thing, we might have avoided the chaos. But hindsight's 20/20, and apparently so is greed. The big lesson? If something sounds too good to be true, like getting a 6-bedroom mansion on a barista salary, chances are it probably is. The financial world is like a party. A little fun is fine, but if everyone's dancing on tables and setting off fireworks inside, it's only a matter of time before the fire alarm goes off. That's it for today's breakdown of the 2008 financial crisis. Thanks for hanging with me. If you liked this video, you're gonna love the one on your screen right now. It's packed with even more great information for you to enjoy. Click it, and we'll see you on the other side.